The Reserve Bank of India, or RBI, compiles and releases bank credit figures every month. The central bank classifies this data under two segments: food and non-food credit categories. Food credit is given to the Food Corporation of India and states for procurement of food grains, while other categories of loans come under non-food credit. According to the latest RBI data, the non-food credit offtake remained robust across sectors, industry, services, and retail in October. Non-food bank credit rose to 18.3% in October 2022 as compared with 6.9% a year ago. An analysis of absolute growth credit between October 2021 and October 2022 indicates that four segments, NBFCs, large corporates, trade, and home loans together account for 51% or 95.5 lakh crore rupees of the total 18.8 lakh crore rupees lent by banks during the period. Personal loans expanded by 20.2% in October 2022 as compared to 12.6% a year ago. It was largely driven by housing and vehicle loans. Housing loans jumped by 16.2% to 18.25 lakh crore rupees in October this year as against 15.71 lakh crore rupees a year ago. Credit card outstanding also soared by 28.4% to 1.79 lakh crore rupees, a rise of 62,000 crore rupees in a year. Vehicle loan outstanding rose by 22.1% to 4.61 lakh crore rupees from 3.77 lakh crore rupees a year ago. The rise in personal loans is complementary to the recent GDP data, which shows that private spending has remained robust over the past 2 quarters. It was above 20% in Q1 and fell to 9.7% in Q2. So what are the key factors driving personal loans and private spending, and why has spending fallen in Q2?
Now, rightly pointed out, inflation has continued to remain high, elevated. But what has driven personal loans is largely the resumption in services, the complete opening up of the economy after the pandemic. Added to that, we saw a very healthy festive season demand coming back to the economy almost after 2 years of being subdued demand growth in during the pandemic. And not to forget that personal loans also incorporate not just housing and vehicle loans, where we did see traction coming in, but also they incorporate education loans, where we did see students now moving out of the country could have tapped on to higher education loans with travel restrictions being lifted. And also, there's another category within personal loans, which is other personal loans, which is largely consumption oriented loans, which could be for, say, for the purpose of marriage, could be for purpose of medical, could be for purpose of travel, etc. Consumption is bound to take some hit, urban consumption more so, from the hike in monetary tightening that we have seen. The past impact of cumulative monetary tightening of almost 190 basis points has so far not trickled down to the consumers, which is going to have a lagged impact going forward. So that definitely is going to be one reason. The other reason, obviously, is that the pent up demand that has so far supported the economy cannot continue unfettered. So there is only a certain limit to which consumers will consume consumer durables or services, and there wouldn't be a continuous repeat fashion of consumption on those fronts.
Credit growth to industry, however, rose only 13.6% in October 2022 from 3.3% in October 2021. Size-wise, credit growth to large corporates increased by 10.9% against a contraction of 0.4% a year ago. The share of loans to the industry sector in bank credit has shrunk to 25% from 27% in the same quarter last year. Medium industries recorded credit growth of 31% in October 2022 as compared with 35.1% last year, while credit to micro and small industries rose by 20.4% from 14.6% a year ago. So why isn't the industry buying more?
I think when you look at on a relative scale, shares do indicate a decline in industry, but I think that's also relative. If you take a deep dive into industry growth numbers and how credit has grown for industry, I think that is also a very interesting trend where we see growth in within the industry also rise, a very healthy credit growth offtake that the industrial sector has witnessed. And a large part of this of late has been driven by credit offtake to large enterprises. So there are two other important reasons. One, obviously, is the need of working capital that has gone up amidst the rise in commodity prices that we've seen. Second is that there has been a fair degree of substitution in demand for credit away from capital markets in favor of banks.
The slow rise in industry credit offtake does not match the steady investment numbers. Investment grew by 10.4% in Q2. Government spending too fell by 4.4%. What has then been the major source of investment in the Indian economy? And going forward, a contraction in manufacturing and global slowdown effect may put a question mark on demand in the second half of the ongoing financial year.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.